Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, May 28th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading week. And it's the last trading week of May 2024, so get ready for June, right around the corner. Summer's about to begin. It's kind of hard to believe we're already close to halfway through the year, but the market, doesn't seem to be too tired. We continue to move higher. We did have a little bit of a hiccup last week. It was a bifurcated kind of week. We had the Dow Jones dropping some ground last week, losing about 2% or so, while the Nasdaq, on the other hand, gained over 1%. So the performance last week certainly varied depending on where you looked. We did see some strength in some of the growth areas. Semiconductors continued to perform really well. Got some strength from some of the retailers last week, but we also had some areas that were not performing nearly as well, including areas like energy with crude oil prices dropping. So as we kick off a new week and get prepared for a new month, we still see, overall the major indices looking pretty good, although that same bifurcation that we saw last week seems to be hitting us again this morning. Futures right now, we've got the Dow Jones futures, or at least looking at the diamonds, down just fractionally, down 22 cents, which is 0.06%. The Spider is actually up about 75 cents. That's a little bit more than 0.1%. The QQQ is up $1.12, back to 459.07, so getting back close to its all-time high. That's up about 0.25%. And then we've got the small cap IWM up $1.24 to 206.68, and that is about 3/5 or 6/10 of 1% higher. So we've got a little bit more bifurcation today. I know that brings out a lot of folks that talk about breadth not being what it needs to be. We saw what happened. The market eventually, other areas of the market came up, strengthened, and as a result, we had a wide participation rally to the upside. So I personally have never really found those breadth indicators to be of a whole lot of use. A lot of times they seem to work only using hindsight. Sometimes they work, sometimes they don't. You don't know which is which until you're further down the road. That's just my personal opinion. I know a lot of great technicians, people have a lot of respect for, use breadth indicators. I haven't found how it's really helped me calling the market. And so I tend to not talk about it a whole lot because I don't use it. Anyhow, why don't we go ahead and jump into the action from last week, show you how things wrapped up. You can see the Dow Jones, and let's kind of zero in here a little bit for you. But the Dow Jones, you can see how it turned down last week. So it was down more than a couple percent. Remember last Friday, not the Friday before the holiday weekend, but the prior Friday, we had closed over 40,000 on the Dow, I think closing 40,003. And then 1 week later, we closed at 39,069. So we gave up 1,000 points on the Dow, which, 1,000 points is not the same as it was 30 years ago, but still 1,000 points off of 40,000. Certainly a pullback, some profit taking going on in the Dow. We did close below the 20-day moving average on the Dow, but we held the 50. We'll see if that 50 continues to hold. If not, maybe we have further bifurcation ahead, or maybe it'll be the start of a little bit more selling. I can tell you that historically, and I don't like, I think sometimes when I talk about the history and I talk about tendencies, listeners are thinking that I'm giving my opinion that the market's going to go up or down based on history. I'm not calling the market up or down when I give historical information. I'm simply just passing along tendencies. Sometimes they work, sometimes they don't. It's just, to me, it's just another secondary indicator in the market. So you got a lot of different pieces of, the puzzle when you're trying to put together where you think the stock market might head. To me, that's just one piece of the puzzle. But having said all that, this week starting, it's actually the dates, I believe, start on the 26th of May. And on the S&P 500, I believe, run through June 5th. And then on the Nasdaq and the Russell 2000, I believe, run until June 6th, but still starting around the May 26th timeframe. So this week, historically, is a very solid week for the market. We'll see whether or not that plays out again this year, but at least historically, that has been the case. And that's typical, really, with most months as you go into the end of the month and the beginning of the next month. It's the prep of additional money coming into the market the following week. And then when the actual money comes in from 401ks, pensions, and so forth, when that money comes in the beginning of the month, that normally will drive prices higher. Anyway, S&P 500 on Friday did finish up 37 points. That was 0.7%, so pretty good action there. But it was all contained within that bearish engulfing candle that we saw on Thursday. And we'll see whether or not that bearish engulfing candle, that would be one of those secondary indicators that would suggest we go lower. So we have two right there battling one another. History says we're going up. The bearish engulfing candle says we're probably going to go down first. Which way do we go? Obviously, one side has to be wrong. We'll find out. At least for now, futures seem to be okay starting off the week. The Nasdaq 100 up 185 points on Friday. That was up a full percentage point. Still within that bearish engulfing candle, but much closer to a breakout on the Nasdaq 100, where you are now on 19,000 watch, closing on Friday at 18,808. We've never closed on the Nasdaq 100 above 19,000, but we are getting close. Mid caps, the S&P 400 mid cap index gaining about 0.8%, and it was right on time because we had been moving lower for the last week or so. Got back up and closed 2976. 20-day moving average, 29.75. So we literally closed right back up 1 point above that 20-day moving average. We'll see if we can extend that today. IWM, small caps, up a little over 1%. So the IWM up $2.20 to 205.44. Like I said, early morning action. We've got another dollar and change added onto that, now trading well up over the 206 level. But this was also one that rebounded, closed at 205.44, which was above the 20-day moving average, 204.69. So we saw some weakness, especially on Thursday, but we did get some nice rebounding on Friday. Transports, still nothing good to say really about this. Only thing I can say about the transports is that when you do look at it on a weekly chart, it doesn't look nearly as bad as it does on a daily chart. Don't know if that's helping a whole lot because there are some other signals. I really don't like this AD line that's going right down with it. It's telling me that there's probably a lot of distribution within the transports. Why? Again, puzzle piece right here. This one is bearish. So we can start lining up a lot of different puzzle pieces. For me, the ones that carry the most weight, I'm really big on that long-term sentiment indicator, which when it's coming down, I'm talking about the 253-day moving average of the equity-only put-call ratio. When that long-term moving average is falling, the stock market has a history of going straight up. So you want to be careful anytime we're coming out of a time period when we've seen a lot of not only weakness, but also a lot of fear and panic, according to the 253-day moving average of that equity-only put-call ratio. And we were very, very pessimistic. The market was panicked back during the 2022 cyclical bear market, and that's what's been where we've seen this rolling over. This tends to last 2-3 years sometimes while this moving average is coming down. So I wouldn't be surprised if this goes well into 2025. Not saying we're not going to have pullbacks along the way. I'm just saying overall, I believe the stock market continues to perform well later this year and into 2025. Although I do believe over the summer we will have maybe a little bit more significant pullback, more than just 3 to 5%. I think if we're going to have something like that, I would probably be looking sometime late July and into August and September. So that's, anyway, the way I evaluate the market, that's what I'm seeing. But anyway, transport's needing some help. that would really help the stock market, and it would help me feel a whole lot better about our economy for sure. Moving on to the sectors, communication services led on Friday, jumping over 1.25%. I think we've got a cup here that's completely formed. Maybe sideways action, put in the handle, but ultimately a breakout above about 83.5, 84 is what we're looking for. And this is a 6-month candle glance chart that we're looking at here. If we go back further, a couple of years, you'll see that this 83, 84 level resistance does go back. We had a previous high in that range. I think it was a couple of years back, maybe right before the cyclical bear market. But anyway, this is a pretty big level to keep an eye on for sure. Utilities having a good day on Friday, gaining almost 1 full percentage point, continues to move up. We did see some weakness earlier last week, but that rebound on Friday kept us well above that rising 20-day moving average. Utilities typically don't lead for very long, especially in a secular bull market. So this has been nice. It's been a counter trend rally as far as relative strength goes. Utilities had been underperforming the S&P 500 by a mile prior to this move back to the upside. So again, take everything into some perspective. Utilities are leading. I don't believe it lasts, but for now, as long as it continues to trade above the 20 and the 20 is above the 50, it's hard to argue with it. Discretionary stocks, haven't talked about them in the top sectors very often, but they were up almost 1 full percentage point on Friday. Still not looking great though on the chart. I mean, if we go back over here, we look at communication services. Like I said, we're near the highs, trying to make a big breakout. And when I look at discretionary, not so much. Renewable energy, huge week. What I can tell you when we look at this index, the DWCREE, it is a renewable energy index, but it primarily just follows First Solar. And First Solar last week went up 40%. This index last week went up 40%. The overall group did well. I know that TRAN, which is a renewable energy or solar ETF, that went up about 10 or 11% last week. So the overall group still did pretty well, but it was really First Solar, when you're looking at that renewable space, that had such a huge week. Enphase Energy is another one I'm watching because it did close at about a 2-month, maybe 2.5-month high on Friday. The volume picked up. So ENPH will be one maybe to keep an eye on. This is a group that you need to have quite a bit of risk tolerance. You shouldn't really pay much attention or even invest in this area unless you're willing to take on some risk to the downside as well. But when this group moves, as I've said many times, when renewable energy gets going, they can move as fast, if not faster, than semiconductors. They're a very rapidly moving industry group when they get going. And you can see that simply by what First Solar did last week. Apparel retailers jumping. This is a group that I would not do a whole lot of long-term investing in. I wrote an article over at Stock Charts yesterday. If you haven't read it, you probably should go over and take a look at it. But I was talking about the steps to becoming a more successful trader. And one of the things when you're considering entering a stock, you have to really consider how long you're planning to hold a stock. If it's a short term, you're getting in, you're going to get out that same day or within a couple of days or even a week or two, you can probably ride strength in any industry group and you'll be fine because you're going to be getting out quickly. I can tell you that the apparel retail group is one group that long-term isn't a great performer. These stocks go up when the economy heats up. Maybe there's some specific products within certain companies and they get moving. But long-term, you're not going to find too many great stocks in apparel retail to hold for the long term. So you need to know the industry group you're in. You need to know the history of that industry group. I'm not just talking about the history of this year, last couple of years. I'm talking about go back to the turn of the century and see how these different industry groups perform longer term. And that'll give you a better idea how long to hold stocks within these groups. So when they're hot and if you're a momentum trader, it's awesome. You jump in, go for the ride. But again, if you're picking something for the long term, check the long-term history, not only on the industry group, but also on the stock that you're looking at. Finally, footwear, another consumer discretionary area. Footwear jumped 2.77%. And you can see that, I don't know, that might be the start of something. This is a group that's been beaten down for quite a while. We were starting to strengthen, putting in slightly higher lows and rising pretty slowly. And we had this right around 2040 or so was support on the way down. You can see like that triple or quadruple bottom that was in play there. We bounced off of it, and then we gapped down to that 2040, 2050 level and sold off. Now we're coming back, and on Friday closed at 2060. So we do have footwear looking much, much better there. AD line needs some work there, as it does in the apparel retail group. But just simply talking about price, does look like we're finishing maybe the right side of a cup on apparel retail. And maybe, just maybe, this move on Friday maybe lights a fire under the footwear group. All right, moving on, 10-year Treasury yield. Let's get an update here. It is down today, so we're at 4.46, which is down a little less than 1 full basis point, a little bit more than a half of 1 basis point. So it's not down much, but we're sitting right at a key area. And I'll zero in on this chart too, because I want you to focus on 2 levels that I pointed out last week and that I've been watching. Right now, I call this a short-term downtrend. We have a lower low, then we had a bounce. We put in another lower low, came back up so far, a lower high. Lower lows and lower highs, that's the definition of a downtrend. So we have that until we get through about 453 or so, 453, 454. If we close at that level or above on the 10-year Treasury yield, then this uptrend would look like it is beginning to resume again. And we need to watch that, especially for the small caps, because we know that that has had a negative impact, particularly on small caps. I mean, it's had a negative impact on the market in general. You can see the jump in April. That came during the period where we had a big drop in the S&P 500. So if we do break back up above 454, expect more volatility in the market, and maybe even, maybe some continuing selling after that bearish engulfing candle that printed last Thursday. Anyway, 454, watch that to the upside. To the downside, right now we're just hovering at these moving averages. A big red filled candle moving back down toward that 432, 433 area, I think would be, it would start to make, it would feel more like a continuation of the current downtrend that we're in. Of course, that wouldn't actually confirm until we get a breakdown below that low. All right, S&P 500. Let's move on to this daily chart. Actually, I'm going to step it up. There's the, let me show you this bearish engulfing candle on the chart that you can see it pretty clearly right here. And if you look, I mean, this wasn't exactly a reversing bearish engulfing candle because we had already started to drop. This one you can see was right off the top, and it was NVIDIA's earnings. So we got a big push up because of NVIDIA. That's the way some tops do form. So we do need to pay attention to it. It would be another one of those secondary signals that I would think is a little bit bearish. It's not a sign that suggests a bear market's around the corner. That's not what candlesticks do. They're very short-term indicators. But, I mean, that type of a candle anywhere on the chart's not going to be a good-looking candle. I don't like red-filled candles, big red-filled candles like that, because it's a sign of distribution throughout the day. Really doesn't matter when it occurs. But when you do see it at the top, they are considered reversing candles. But many times can be reversing only for a day or two. Anyway, with that candle, I wouldn't be shocked to see a 20-day test. I mean, that wouldn't be much further below where we are right now, down to maybe the 5240 area. But anyhow, you can kind of see these when you start seeing big red-filled candles, you got to be a little bit more cautious, the market. And so, when I see things like this and I say, be cautious, the market, things like that, I'm sticking with the long side. I want to be clear about that. I am bullish. I've been bullish. I've been bullish almost entirely off of the 2009 low, to be quite honest. But certain things happen where you break out, you get more bullish. There are other times you get some cautious signals where you just get a little bit less bullish, but you're still bullish. So I just want to be clear. I'm bullish. I think the market goes higher. Doesn't mean we couldn't go down this week. It doesn't mean we won't go down 5 to 10% over the summer. It's possible. Would not shock me at all. That's just, again, a historical pattern in many years, but especially in presidential election years. So keep all that in mind, but don't lose sight of the long term. And so if I'm thinking about this and you say, okay, long term, you're bullish, and short term, you're cautious, or there are some cautious signals, what do you do with that? For me, I stay long. I don't see anything that says we can't go higher, and we're in a secular bull market, so I don't bet against the market. What it does impact me, though, is I'm not going to do leverage. I'm not going to use leverage when I've got signs. I mean, even that bearish engulfing candle right there would tell me not to do leverage. Just that one signal right there. So I'm not interested in leveraging. I want to make sure that I feel comfortable that I can manage my risk to the downside. I mean, I can manage it at the 20-day moving average, but if I'm going to do leverage, a lot of times I want to do it at the 20-day. Why do it above and have losses, triple losses, when you hit the 20-day? Makes little sense. So that's how I approach it. Short term, if I'm a little bit nervous, I just stay away from leverage. I might do more ETFs. I might do less individual stocks, something like that. That's the way of managing your risk without selling or shorting. I do not short secular bull markets. You're not going to hear me talking about doing extended short trades. Unless my signals suggest that we're topping and it's, perhaps a more significant top, I'm not interested in shorting. Nasdaq 100, same thing. There's that bearish engulfing candle. We did rise, jump up on Friday, but we didn't clear. When you have a bearish engulfing candle, it's in play until you clear it. So we've still got a little work to do across our major indices. IWM, small caps, you can see Friday, definitely weak. Not a bearish engulfing candle. Well, technically, I guess it is from the prior day, but not one from the top. So we talked about potential of a cup here, possibly pulling back to the 20-day. This one actually went down almost to the 50-day. Now we're back up above the 20. A breakout above this 210, 211 area. I would say 211. If we can get a close above 211, that would be bullish for the small cap area. So let's keep watching for that. And then there's your transports. Again, what I said earlier is if we pull up a longer term chart, I mean, if this is a 5-year weekly chart, it's not exactly been going up with the stock market, but it's not breaking down. A few weeks ago, a couple months ago even, we were talking about, getting close to those all-time highs. We almost had that Dow theory where, transports, you need to have breakout to an all-time high to confirm the breakout in the Dow Jones that we've already seen. We didn't quite get there, but just a couple months ago, we were almost there. And so right now we just continue to consolidate. If we pull up a 15-year monthly chart, now all of a sudden, what are we looking at? Is this an uptrend or a downtrend? And this is one of the things I talked about in my article over the weekend. Look from left to right. Are you going up or down? I think it's pretty clear here that we are going up. Been going up. We have periods of down, but the overall trend over the last 20 years, or 15, what is this? 15-year chart. For the last 15 years, the trend obviously is up. We've had periods of weakness. So again, you get a different take when you use perspective. When you look at the daily chart, it's hard for me to say many bullish things about what I see on the daily chart. But then when you step back to the weekly, and especially here on the monthly, I really don't have anything bearish to say on the monthly chart. I think transports are fine. Maybe underperforming the S&P 500 and not confirming the Dow breakout that we saw. But I don't see anything bearish. I mean, look at the PPO, monthly PPO. For the last 15 years, it has been since, 2010, when it broke above the center line. PPO has been above the center line the entire time, except a very brief period during the pandemic. Otherwise, that's one of the things I say. A PPO above the center line, that's above zero, it's bullish. I don't care about whether it's under the trigger line, above the trigger line. It's bullish. It means your short-term moving average is above your long-term moving average, which to me is bullish. When you are below the center line and you're in negative territory on the PPO, then you've got bearish momentum. Can't question it. It's bearish. All right. I want to just remind everyone, you can go over to EarningsBeats.com. If you're new to the show, new to EarningsBeats, go over to our website. Couple things. First, we do have a free newsletter, completely free, 100%, no credit card required. You can unsubscribe at any time. We do this simply to provide our community some education, trading education, perhaps some trading opportunities. Of course, if you decide to trade any of the stocks, that's completely on you. But we just, try to show and communicate the things that are important to us at EarningsBeats. That's the whole purpose of this newsletter. I think it will help in your trading, even if you don't follow us exactly what we do. And I wouldn't do that. I mean, you need to do what works for you. But I think if you incorporate some of the things that we talk about and that are important to us, I think that will help in your trading. Anyway, name, email address, all it takes. And the EarningsBeats Digest will be out Mondays, Wednesdays, and Fridays, except on holidays. We didn't have one yesterday because of the holiday. Also, best time of the year to subscribe, become a member at EarningsBeats.com. That does require a credit card, and there is a cost, but this is going to be your lowest cost deal of the entire year. It runs through June 2nd, so we've got still almost a week left coming up. So you definitely want to make sure you don't miss out on that. In the meantime, you can start a 30-day no-cost trial. If you like the service and you really want to be part of this community that we've built, you can extend using the best deal of the year. So it's a great time to start a trial and check us out. Love to have you. All right, so today's chart of the day is Deckers. Last Thursday after the bell, they reported their earnings, another blowout report. And after sideways consolidating for a few months, Deckers broke out again. I suspect, I'm not saying it's going to go up right now from this level, but I suspect we're going to see some higher prices ahead. So far, we only have 1 day's worth of trading after the earnings report was out, but it was a very solid day to the upside, breaking to another new all-time high on Deckers. This is a stock that's been one of the best performers over the last couple of years. And if we go back and take a look at a 5-year weekly chart, I mean, look at this. Look at the lows from 2022, the cyclical bear market back, let's see, May of 2022, we were as low as about 215 maybe. We closed Friday at 1,033. So we have seen this stock quadruple, more than quadruple, actually close to quintuple over the last less than 2 years. So it's been a really hot stock. They came out with another blowout report. These are the types of stocks. Now, this is in the footwear space. And if I showed you footwear, and I do it relative to the S&P 500, you can see footwear has not been a very good group. And if I take this same chart out 15 years, you can see it's an okay area. What this means when it's going sideways like this over a long period of time, it means that footwear is going up at about the same clip as the S&P 500. So when you're getting into periods where it's rising, you're outperforming. Footwear goes through periods where it outperforms for an extended period of time. Then it can also underperform for an extended period of time, back up again, and then mostly down over the last couple of years. So while footwear has not been particularly strong, we have a stock like Deckers that has been absolutely crushing it. So clearly it is a leader in the space. And we talk about if you're going to invest and you want to beat the S&P 500, you need to stick with leaders. Deckers is certainly one of those. Okay. Actually, we got 1 minute left, so pretty good timing. I am going to take one look. If you want to, if you have some strong areas or areas that do tend to do well over time, I mean, we're talking about semiconductors, we're talking about software, internet stocks, some of the areas of retail, specialty retail. Just pick a group. Let's just say specialty retail. And for whatever reason, right now, you're really interested in specialty retail. Let's just take a look at the group. So we were a little weak during April, like most of the market, but it's bounced back. We're above the moving averages. We're now testing both the 20 and the 50. Let's say this is a group that you're interested in. Where do you go from here? Well, it's pretty easy for EarningsBeats members because you would go into strong earnings chart list. I like the raised guidance chart list. These are companies that not only are telling you that they beat last quarter, but they're also telling you that we really see good things ahead. So I really like this raised guidance chart list to work off of. But if you do view all and go in here and hit summary, it'll list every one of these stocks over whatever period it is that you want to look at. You could maybe look at the last month, see what's gone up, which is right there. These are the best performers over the last month. And then if you want, maybe look at some that haven't performed very well. And you can see not very good here, even though they have raised guidance. Doesn't mean they all go higher. But look at the scooters as well. I mean, I would like maybe to do or to look at a stock that's been doing really well, has a high scooter, but maybe over the last week has been weak. So if you hit the scooter, it's now sorted. The entire raised guidance chart list is sorted by the highest relative strength scores here based on the scooter, which is the stock chart's technical rank. And then you can go in and actually you could type in, if you want, specialty retail. Specialty retail, and see there are 3 stocks on here in specialty retail that have raised guidance. One stands way above the other 2. Williams-Sonoma, this stock gapped up big time. They had a great earnings report that came out. They gapped up huge and then had a massive sell-off. Personally, I think it's probably a great opportunity. You can see it right here. Big gap up, big sell-off, but we're still holding major support, which is the gap support from a few months ago from prior earnings. So I think we could go as low as 260. I don't know if we'll get all the way down there. We've tested this other area of support closer to 280, and we seem to be bouncing off of that right now. And here you can see that gap up. It was just one day of selling. We've kind of been working our way. Right now, we're just kind of going sideways. But this is one that, to me, if you want to look at something long-term, let's go back 15 years. This is the type of stock where you can build wealth. If I'm thinking about a long-term trade, I want a chart that looks something like this. If we go back and let's say look at, how about we pull up maybe clothing and accessories. All right, let's pull up a couple of these and just see, I don't know, pull up Gildan Activewear. This one's sideways. I don't have any idea what the long-term chart. I mean, it's been going up, but if you look, we're really not far from where we were 9 years ago. I mean, 9 years ago, the stock hit 30, and here we are now at 37. So it hasn't exactly been a great long-term performer. So I wouldn't be as excited about a stock like this as I would something like Williams-Sonoma, because it's got that long-term track record. So when you get pullbacks in a stock like that, I tend to be a little bit more, I tend to find those more favorable. All right, let's take a look at what's going on as the market has now opened. We got the Dow down 133. So here's that bifurcation that we saw last week. Dow down, S&P up a little, Nasdaq up more. Small caps up, but not about 0.5%, it looks like here. So overall, and there's end phase, by the way. After closing, I'll show you that chart. This was the close. You can see the volume last few days has been pretty good as it moves up. Last 2.5 months, we had not been able to close above about 122. No opens, no closes above 122. Here, we closed at 125. I think this is a stock that could potentially run up to about 140. If we get through 140, this is the type of stock that could melt up. So I'm watching it pretty closely. I actually did buy some of it at the end of last week. But that 140 level is a big level for me. So we'll see what happens there. But again, this is a very volatile stock. I mean, you can see it looked great, big volume back here. And look at what happened. The stock in a month and a half, dropped from that 140 level down to 95. So this type of stock, these stocks in the renewable energy space, bring a lot of risk with them. So yes, they can make big moves to the upside. Just make sure you're comfortable with the risk to the downside. All right, that's it for me. I appreciate everyone tuning in. Let's see what this week brings. I'll be back tomorrow morning at the same time, 9 a.m. Eastern. That's when we do this, Tuesday, Wednesday, Thursday. So if you are new to the program, make sure you come back, you tune in. Please hit that like button and subscribe to our channel. That really helps us in building our YouTube community. It really definitely is very much appreciated by all of us at EarningsBeats. Listen, everyone have a great rest of your week. Make sure you sign up. Spring special, got 5 days left. Don't miss it. Have a great day, everybody. Happy trading.